Module 2, Economy. In this lesson, we are going to learn how the economy affects the stock market. Many people look only at charts, but the market also moves because of important economic information. We will focus on 5 major areas: inflation, interest rates, jobs, growth, and the Federal Reserve. Inflation tells us how fast prices are rising. Interest rates show us the cost of borrowing money. Jobs data tells us how strong or weak the labor market is. Growth shows us whether the economy is expanding or slowing down. And the Federal Reserve, also called the Fed, makes major decisions that can move the market very quickly. When traders understand these economic signals, they can better understand why stocks, bonds, commodities, and currencies are moving. This helps us make smarter decisions instead of guessing. By the end of this module, you will understand how the economy connects to the market and why every serious trader must pay attention to economic news. Lesson goal. Before we go deeper into the economy, let's understand the main goal of this lesson. By the end of this section, students should understand why the economy matters to stocks and indexes. The stock market does not move only because of charts. It moves because investors are constantly thinking about the future. We will learn which economic reports can move the market, such as inflation, interest rates, jobs, and growth. These reports help investors decide whether the economy is strong, slowing down, or at risk. The main teaching point is this: students should not look at charts alone. Before taking a trade or making an investment, they should ask, what is happening in the economy right now? The economy creates the background for every trade and investment. Even a good chart setup can fail if the economic environment is against it. So always remember, the market moves on expectations, not only on today's news. What is the economy? Before we can understand how the market moves, we need to understand what the economy actually is. The economy is the system that connects money, jobs, businesses, banks, consumers, and government policy. All of these pieces work together and affect each other. The economy includes people working and earning income. When people have jobs, they have money to spend. Consumers then spend money on products and services, which helps businesses make sales and profits. Banks also play a major role because they lend money to people and companies. There are also big moving parts in the economy. Governments spend money, central banks set interest rates, businesses hire workers or cut costs, and investors decide where to put their capital. This connects directly to the market. When the economy is strong, companies may earn more money and stock prices can rise. When the economy is weak, company earnings may slow down and investors may become more careful. One important point is that markets often react before the data becomes perfect. Investors are always trying to predict what comes next. So the economy is not separate from the market. It is the background that helps explain why the market moves. Why the economy matters to the stock market. The stock market is forward-looking. That means investors are not only looking at what is happening today, they are trying to predict what may happen in the future. Stocks can rise when investors believe the economy is improving. For example, companies may earn more money, consumers may keep spending, inflation may start to cool down, interest rates may fall, and confidence may improve. When this happens, investors become more willing to buy stocks because they believe future company profits can grow. But stocks can also fall when investors become worried. If inflation stays too high, interest rates remain elevated, jobs begin to weaken, company profits fall, or recession risk increases, investors may become defensive. This is why economic reports are so important. They help the market decide whether the future looks stronger or weaker. The key lesson is this: markets often move before the economy officially improves or weakens. Investors try to react early before the full story is clear. Inflation. Now, let's talk about inflation. Inflation means the prices of goods and services are rising. In simple words, the same money buys less than before. For example, food costs more, gas costs more, rent costs more, wages may rise, and business expenses can also increase. When prices rise too quickly, it can create pressure on consumers and companies. There are a few important reports traders should watch. CPI measures consumer inflation. PCE is the Federal Reserve's preferred inflation measure. PPI shows producer and business costs. Wage growth is also important because rising wages can add pressure to inflation. Inflation matters because it can pressure the stock market. If inflation stays high, central banks may keep interest rates high. Higher rates can slow down the economy, reduce consumer spending, and hurt company profits. Another important point is company margins. If businesses pay more for wages, materials, shipping, and rent, their profits may shrink unless they can pass those costs to customers. So when inflation is high, investors become more cautious. They start asking, will the Fed raise rates, keep rates high, or slow the economy down to control inflation? That is why inflation reports can move the market very quickly. Interest rates. Now, let's talk about interest rates. Interest rates are one of the biggest drivers of the stock market because they affect borrowing, spending, business growth, and investor behavior. When interest rates are high, loans become more expensive. Mortgages cost more, businesses may spend less, and consumers may slow down their spending. When borrowing becomes harder, the economy can slow down. High rates can also pressure stock valuations. This means investors may not be willing to pay as much for stocks, especially growth stocks, because future profits become less attractive when rates are high. On the other side, when interest rates are low, borrowing becomes easier. Businesses can expand, consumers may spend more, and stocks can become more attractive to investors. Risk appetite can improve, meaning investors may be more willing to buy stocks. The simple rule is this: higher rates can pressure stocks, while lower rates can support stocks. That is why traders always pay attention to interest rate decisions, Fed meetings, and comments from central banks. These can move the market very quickly. Jobs market now. Let's talk about the jobs market. Jobs data tells us whether people are working, earning money, and spending money. This is very important because consumer spending is a major part of the economy. There are a few key reports traders should watch. Non-farm payrolls show how many jobs were added. The unemployment rate shows how many people are out of work. Wage growth tells us if workers are earning more money. Jobless claims show how many people are applying for unemployment benefits. And JOLTS job openings shows how many jobs are available in the economy. Strong jobs can help the market because people with jobs usually spend more money. That can help companies sell more products and services. Strong jobs can also improve consumer confidence. But there is one important warning. If jobs are too strong and wages rise too fast, inflation can stay high. That may cause the Federal Reserve to keep interest rates higher for longer. Weak jobs matter too. If jobs start slowing down, layoffs increase, or unemployment rises, investors may worry about a recession. At the same time, the market may also expect the Fed to cut interest rates. So the key lesson is this: sometimes good economic news can be bad for stocks if it keeps interest rates high. Economic growth. Now let's talk about economic growth. Economic growth tells us whether the economy is expanding or slowing down. When the economy is growing, businesses usually sell more products and services, consumers are spending, and companies may earn more money. Some important growth reports to watch are GDP, retail sales, consumer confidence, ASM manufacturing, ASM services, and durable goods. These reports help traders understand whether the economy is strong, weak, or changing direction. When growth is strong, companies may increase sales, earnings can improve, investors may be willing to take more risk, and bull markets can become stronger. But when growth is weak, company revenue may slow down, future guidance can weaken, unemployment may rise, and investors may move into more defensive sectors. The key point is this: growth affects company earnings. And because stock prices are based on expectations of future earnings, growth reports can have a big impact on the market. So when you look at the market, always ask, is the economy growing, slowing, or starting to weaken? The Federal Reserve. Now, let's talk about the Federal Reserve, also known as the Fed. The Fed is very important because it controls interest rate policy and strongly influences market expectations. Traders pay close attention to the Fed because its decisions can move stocks, bonds, currencies, and commodities. The Fed watches many parts of the economy, including inflation, jobs, economic growth, consumer spending, and overall financial conditions. When inflation is too high, the Fed may raise interest rates to slow the economy down. When growth is weak or the economy needs support, the Fed may lower interest rates to help borrowing and spending. Sometimes the Fed may also hold rates steady when the future is uncertain. Even if they do not change rates, their speeches and comments can still move the market because investors are listening for clues about what may happen next. Traders care because Fed meetings can create big market moves. Bond yields often react quickly, and stocks usually follow expectations about future interest rates. The key lesson is this: the market does not only care what the Fed does today, it cares what the Fed may do next. Market cycle. Now, let's talk about the market cycle. Markets often move through repeating phases as investor expectations change. The economy and the stock market do not move in a straight line forever. They go through stages. The main cycle is expansion, peak, slowdown, recession, and recovery. During expansion, the economy is growing, companies may be earning more, and investors usually feel confident. At the peak, the market may be very strong, but risks can start building. Prices may become expensive, inflation may rise, or the Fed may keep rates higher. During a slowdown, growth begins to weaken. Companies may lower guidance, consumers may spend less, and investors may become more cautious. In a recession, the economy contracts, earnings may fall, unemployment may rise, and markets can become defensive. Then comes recovery. This is when investors begin to look ahead and believe the worst may be behind us. Stocks can start moving higher before the economy fully improves. From a trading cycle view, markets often move from accumulation to uptrend to distribution to downtrend. Smart money often moves before the crowd. The lesson point is simple. Know the cycle before choosing a strategy. The same setup may work differently depending on which phase the market is in. What students should check every week. Now, let's talk about what students should check every week before looking at trades or investments. A simple weekly routine helps traders understand the market environment. Instead of guessing, we want to know what the market is paying attention to. First, check rates and inflation. Look at inflation reports, Fed speeches, interest rate expectations, and bond yields. These can strongly affect stock prices because higher rates can pressure the market, while lower rate expectations can support it. Second, check growth and jobs. Watch jobs reports, GDP growth, retail sales, and consumer confidence. These reports tell us whether the economy is strong, slowing down, or at risk. Third, look for market clues. Pay attention to earnings season, sector strength, oil prices, and the US dollar. These clues can show where money is moving and what investors are worried about. The lesson is simple. Before trading, always understand the background. A good trader checks the economy first, then the chart.
Economy lesson summary. Now let's quickly summarize what we learned in this economy lesson. The economy creates the background for almost every major market move. Stocks do not move only because of charts. They move because investors are watching profits, confidence, interest rates, inflation, jobs, and growth. The first key takeaway is that the economy affects company profits and investor confidence. When the economy is strong, companies may earn more and investors may take more risk. Second, inflation and interest rates are major market drivers. High inflation can keep rates high, and higher rates can pressure stocks. Third, jobs reports show consumer strength and wage pressure. Strong jobs can support spending, but strong wage growth can also keep inflation higher. Fourth, GDP and retail sales help show whether the economy is growing or slowing. This helps traders understand the bigger market direction. And finally, the Fed can move markets through rate decisions, speeches, and comments. Sometimes what the Fed says is just as important as what the Fed does. The most important lesson is this. Before reading a chart, understand the economic environment first.